Anthony Limited began business on January 1st, 2019. At December 31st, it had a $58,500 balance in the deferred tax liability account that pertains to property, plant, and equipment acquired on July 1st, 2019 at a cost of $900,000. The property, plant, and equipment is being depreciated on a straight line basis over 6 years for financial reporting purposes and is a Class 8 20% asset for tax purposes. Anthony's income before income tax for 2020 was $60,000. Anthony Limited follows IFRS. The following items cause the only differences between accounting income before income tax and taxable income in 2020. In 2020, the company paid $56,250 for rent. Of this amount, $18,750 was expensed in 2020. The other $37,500 will be expensed equally over the 2021 and 2022 accounting periods. The full $56,250 was deducted for tax purposes in 2020. Anthony Limited pays $9,000 a year for a membership at a local golf club for the company's president. Anthony Limited now offers a 1-year warranty on all its merchandise sold. Warranty expenses for 2020 were $9,000. Cash payments in 2020 for warranty repairs were $4,500. Meals and entertainment expenses, only 50% of which are ever tax deductible, were $12,000 in 2020. The maximum allowable CCA was taken in 2020. There were no asset disposals for 2020. Assume the PP&E is considered eligible equipment for the purposes of the Accelerated Investment Incentive. Under the AII, instead of using the half-year rule, companies are allowed a first-year deduction using 1.5 times the standard CCA rate. Income tax rates have not changed since the company began operations. Calculate the balance in the deferred tax asset or deferred tax liability account at December 31st, 2020. Okay, so let's figure this out. So we've got some differences here. So we need to figure out what's happening with our deferred tax asset or deferred tax liability account. Now, one of the things we need to deal with first is this PP&E difference. So PP&E differences are going to require us to run a schedule. So in order to figure out our deferred tax asset or deferred tax liability, we need to deal with all of our temporary differences. So let's start with PP&E. So we're going to run our year down the side. And we've only got 2020. And how many years is this? Property is being depreciated over 6 years for financial accounting purposes. But we're only looking for the deferred tax liability account at December 31st, 2020. So let's just start with 2019. We're going to have our depreciation. We're going to have our net book value. We're going to have our CCA, our UCC, which is essentially undepreciated capital costs. It's like net book value for tax. And then our difference. Okay. So for accounting purposes, so this asset cost $900,000. So we're going to have our purchase price, $900,000. And it's being depreciated over 6 years for accounting purposes. So 900,000 divided by 6. So we're going to get 150 of depreciation per year. Now, for depreciation, it doesn't say this in the question that I can see, but we're going to take the half-year rule for accounting purposes. So the question really should have said that, but for that first year, we're going to take the half-year rule. So let's just assume that, and it would say this in the question. The next year, we are simply going to have the 900,000 divided by 6. So we're going to have 150,000 of depreciation for book purposes. So our net book value is going to be our purchase price minus the depreciation taken to date. And let me just fix this. I didn't put this in there properly. Put 900,000. So here I'm going to say 900,000 minus the depreciation taken to date. So that's going to be my net book value, 825,000, and same thing here. So then here I'm going to go 900,000 minus 150. actually, this should actually be my opening net book value minus the depreciation taken in the period. So now my net book value is $675. CCA is going to start out with the cost of the asset times the CCA rate. And it says that our CCA rate is 20%, but it also says that we get 1.5 times the deduction in the first year because of this AII program. So you can see I've got 20% here, and I've got my times 1.5 just to recognize that one benefit. Now my UCC is originally going to be the purchase price minus the CCA taken to date. Now my CCA is going to be my UCC times 20. And my UCC is going to be the opening UCC minus the CCA taken to date. And that's going to be my closing UCC. UCC minus the CCA to date is going to be my closing UCC. So my difference in the depreciation is going to be my book value minus my CCA. And so you can see the differences there. We usually do use CCC minus depreciation, and that's because it gives us an idea of what is happening. So my depreciation is lower than my CCA, so it's going to be a positive difference. And here my depreciation is higher than my CCA, so you can see it's a negative difference. And these are all reversing differences because in the end, we're going to end up depreciating over the course of the 6 years for accounting, and over a longer period for tax, we're going to end up recognizing depreciation or CCA on the entire 900,000, and that's why it's a temporary difference. So those are my differences for PP&E. So now let's run all of our differences through here. So we're going to have all reversing differences. There we were just looking specifically at PP&E because we needed to do some extra calculations. So here we're going to have all reversing differences. So that is going to be, so we're going to have PP&E, we're going to have PP&E, we're going to have prepaid rent for 2021, and we're going to have prepaid rent for 2022. We could have just done a separate schedule for this, but we didn't. So we've got 2 years of prepaid rent to deal with. And we're going to have the warranty. And those are the differences in the question. You can see here we're only looking for temporary differences right now. So because those are going to give rise to deferred tax. Any permanent differences will not give rise to deferred tax. So here we've got the rent, and you can see there's a timing difference here around the timing. There's a membership in a golf club, but that's a permanent difference that will never be allowed to be deducted. So we'll deal with that later. We've got the warranty, which is a timing difference. We've got the meals and entertainment, which is going to be a permanent difference because half of it will never be allowed to be deducted. And we've got the PP&E. So those are our reversing differences. So for PP&E, our difference here is, so what we want is the tax base, and then the accounting carrying value. And then that's going to give us our taxable temporary difference. Okay, so the tax base, so the key is that looking at deferred tax is a balance sheet approach or a statement of financial position approach. So before we had looked at the difference between depreciation and CCA, but when we're looking at deferred tax, we want to think about it from the balance sheet perspective. So what's our carrying value for tax is our UCC. And what's our accounting carrying value? It's going to be this amount, which is going to be this 825. Actually, sorry, at the end of 2020, I picked up the wrong numbers there. So was the right concept, but so my UCC at the end of 2020 is going to be 504, and my carrying value for accounting purposes is going to be 675. So the difference between these two things, my tax base and my carrying value for accounting, is what's going to give rise to a taxable temporary difference. So once we apply the tax rate to that, we'll get a deferred tax asset or a deferred tax liability. So prepaid rent, what's going to happen here is that it says the company paid $56,250 for rent. Of this amount, $18,750 was expense. The other $37,500 will be expensed evenly over 2021 and 2022, but we deducted this whole amount for tax purposes. So my accounting carrying value is going to be $37,500 So let's just put over here rent. So we have 37,500 divided by 2 is going to be my accounting carrying value. So I'm going to expense that evenly over 2 years. And my tax base is 0 because I've already expensed it for tax purposes. So there's nothing left for tax, but my accounting carrying value is going to be, I'm going to have a 18,750 deduction from accounting income and 18,750 deduction from accounting income again. So my taxable temporary difference here is going to equal this 18,750. Okay. So in order to figure out the deferred tax, we need to run the tax rate across it. So we're going to have tax rate, and we're told the tax rate is 30% for all years. So we can just run our 30% across here. Oh, we didn't fill in the warranty. So let's take a look at that. The warranty, it says it offers a full warranty on all merchandise sold. Warranty expenses were $9,000 and cash payments were $4,500. So what's going to happen is that we would have deducted the cash payment, but we would have had in 2020, the warranty repairs were $4,500. So we can deduct the actual warranty repair amount. So we're going to have the $4,500 here. And again, our tax basis is 0. So now once we run our 30% tax rate, then we're going to have, let's just clear this out. That was just a side calculation. Then we're going to have our deferred tax asset, or if it's in brackets, then it's a liability. And the reason why it's a liability is because if our tax base is lower than our carrying value, then we have less deductions we can take in the future. So we want our tax base to be higher than our carrying value because that means we've deducted less for tax, we can deduct more in the future. We've already deducted more for tax than for accounting, then we can deduct less for tax in the future. It means we're going to have to pay more tax in the future because we're going to have less deductions to offset it. So let's take this times this. So this is going to be deferred tax liability. So we have all deferred tax liabilities here. Oh, and then this should have been picked up here. So we've got all deferred tax liabilities. There. Okay. So that gives us this information. So we've got calculate income tax payable for 2020. Okay, perfect. So just going back here, so on the warranty, so the warranty deduction, when we pay out under the warranty, we've already reduced it for accounting purposes. So let's just take another look at this warranty. So this 37,500 will be expensed evenly over these periods, but the full 56 was deducted for tax purposes in 2020. So what it means is that we've taken everything for tax purposes, but our carrying value from an accounting perspective is still this value of the warranty repairs. So we've got a positive carrying value here. So we actually are going to have a deferred tax asset related to the warranty because we can make a future tax deduction when we pay out those warranty expenses. So these deferred tax assets and liabilities are all in 2020 because we were looking at one specific year. So we can sum these up. Let's just do a sum here. So this is going to give us our total deferred tax liability at 2020, DTL at 2020, December 31st, 2020. But we also need to remember to have the opening DTL. What was our opening deferred tax? So was there an opening deferred tax liability given in the question? And it says that there was an opening balance of 58,500. So the change for the journal entry is going to be the difference between these two numbers. So we're only going to, oh, these are going the wrong way here. So let's change our sign. We're just looking for the difference between the two, which is going to be $2,700. So that's the change that we're going to want to make to the deferred tax liability account. Okay. So now we're asked to record the journal entry for income taxes for 2020. So we know that we have a deferred tax entry, which we figured out here. But don't forget, we also know we need to record current tax expense. And how do we record current tax expense? Well, we record current tax expense by multiplying our taxable income times the tax rate. But have we been given the taxable income? No, we have not. We do not have the taxable income, but we have all these differences. So now we need to do a reconciliation between accounting income and taxable income. We're going to have accounting income. This is specific to 2020. We're only doing it for 1 year here. So our accounting income is going to be, where does it say it? Income before income taxes was 660,000. So we're going to have 60,000 here. And then what differences are we going to have? So let's start by having our reversing differences, because we've already worked on those before. So we're going to have depreciation versus CCA. So what's our difference for 2020? Well, our difference for 2020 is going to be 24,000. Just ignore the signs there. So 24,000. Then we're going to have rent. We're going to add back. So we're going to have rent add back, because for tax, remember how we deducted the entire 56,250? So for tax, we deducted 56,250, but for accounting purposes, we only deducted 87,750. So we're going to add back this 37,500, right? Because that's the amount that we haven't deducted yet for tax. So we're adding it back for tax purposes. And then the warranty, we have a difference of 4,500. So those are all of our temporary differences for taxes. Our subtotal is going to be 66,000. So those are our differences for the temporary differences. Now we're also going to have our permanent differences. So permanent differences, these only come into our calculation of accounting income to taxable income because they're not reversing differences. So we don't need to consider them in our deferred tax liability calculation. So we're going to have golf dues, which are going to be $9,000. Should say golf, 9,000. We're going to have the meals and entertainment, 50%. You know how it says up here that 50% of meals and entertainment are never tax deductible. So we had 12,000. So we're going to take half of 12,000. So 6,000 for that. And that's it, I think. I think we've dealt with everything else. So let's look through this question. So we've got PP&E, we're dealing with that. There's this, the rent, we've dealt with that. We've got the warranty, the golf dues, we've got the meals and entertainment, and the CCA. So we've picked up everything. So now we're going to have our taxable income. Which is going to be this amount. So we're going to have the 60,000. So let's actually run a subtotal in here. Subtotal. So we are going to have we're adding all these things back. And then these are going to be deducted. So let's see about this. 60,000 minus plus 66,000 minus these two is going to give me my taxable income. And this number is not correct. Let's take another look up here. So we're subtracting out this rent difference because this has been included. This has been deducted from tax, but we need to add it back. So we're going to have minus 37,500 for rent. And remember that here we've got accounting income. So we're adding back this difference. We're subtracting the rent. We're adding the warranty. Okay, and then we are adding back these two because they have been deducted from accounting income, but not from taxable income. So we can't include them. We can't take a deduction for those in taxable income. So we have to add them back to make our taxable income higher. So we're going to take this amount plus the subtotal of our temporary differences, and then plus we're adding the golf dues and the meals and entertainment so that we end up with taxable income of $66,000. And our tax rate of 30% is going to be income tax payable of $19,800. So now we can make our journal entries. We're ready to do that. So journal entries for 2020. So we're going to have debit current tax expense. Which is going to be this number here. And credit income tax payable. And then we're going to have our deferred tax. So we're going to go debit, deferred tax expense, and credit deferred tax liability. And it's going to be the change in this account that we calculated up here, which is going to be this $2,700. And those are all of our tax entries there. So we've got our current tax and our deferred tax, and we're always going to have that. And remember, the deferred tax entry is always the change in the deferred account. So always watch for this opening balance. It's really important. Okay, prepare the income tax section of the income statement for 2020, beginning with income before income taxes. Okay, we can do that. Let's move down here. So D here is, what number are we on here? So income, so D is going to be the income statement, P&L, taxes. So we're going to have income before income tax, which is going to be our $60,000 that we were given in the question. Then we're going to have income tax, and we're going to have our current and our deferred income tax, current and deferred. And our current tax was this amount, $19,800, and our deferred tax is $2,700. Just ignore the sign there. Should be positive. So our total, our total taxes, which we just sum on the side here, and so our income, net income, is going to be our income before tax minus our current and our deferred tax total, which is going to be $37,500. So E says indicate how deferred taxes should be presented on the December 31st statement of financial position. Okay, well, we're using IFRS here. So E is going to be statement of financial position. Presentation is going to be non-current liabilities, deferred tax liability. And remember, this was the opening. This is the actual balance sheet amount. So if we look up here, remember how we knew what we wanted to have in here. We wanted to have $61,200. So that's what's sitting in that account now. And again, just ignore that sign. It's going to be $61,200. And remember that IFRS requires all deferred tax to be presented as a non-current liability. In F, we're asked what would happen, how it would be different if we were using ASPE, and ASPE would allow us to have a current tax component or a current liability and a non-current liability component. So what we would have done to figure out the ASPE amount is we would have looked at our future tax liability schedule up here, and we would have separated out the amounts that were going to come in the next year, which would have been this amount and some of the PP&E differences. So we would have had a smaller component for the current future tax liability, and then we would have had our non-current liability as the balance. And remember that under ASPE, we call it future income tax or future tax liability, as opposed to IFRS, where we're talking about deferred tax. And that takes us through the completion of this question.